Why did restaurants close so many locations last year? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business. And in this week's episode of A Deeper Dive, we are talking about the rash of restaurant closures in 2024. A lot of companies closed a lot of locations last year. Many of those companies ended up in bankruptcy, such as Red Lobster or TGI Fridays, but quite a few companies closed underperforming restaurants for strategic or other reasons, such as Wendy's and Denny's. Closures always generate headlines in publications like mine, but there are reasons why companies opt to do this. And so I've roped in old friend Jim Balis to talk about this topic. Jim is the operations partner with the private equity and debt investment firm CapitalSpring, and we often bring him in to talk about issues just like this. Jim, welcome again to the podcast.
Thanks for having me, John. I always appreciate being on the show with you.
All right, cool. Well, let's talk a little bit about closures. You spent a little bit of time observing the restaurant business. Why did we have so many closures last year? What was going on?
I think it's definitely a confluence of factors, but, certainly a number of businesses realized that they had stores that were underperforming and there was no real line of sight to seeing them ultimately perform. And I think a lot of businesses came to terms with the fact that, we have two options here. I can either close this location or spend a lot of capital. And by the way, in capital, I'm referring to both financial capital and human capital, trying to keep this open. And if I can reallocate that capital to another more efficient use that's more productive, let's do that. And it's always a tough decision. And, in addition to a lot of the big brands out there, we have a lot of small founder-led businesses that I'm constantly speaking with, whether we invested with them or not. I always enjoy networking, and a lot of them come to me and say, should we be closing, this location or that location? And I often recommend that they do, primarily for that reason.
Mm-hmm. How do you, the concern that I always have with closures, and I'm pretty certain that you have this as well, though, is that when you start closing locations, consumers see that. And it's not just the publicity that you might get from publications like mine, but, like consumers see closed locations and they start, and if you get too many of them, you could have situations where you just got customers that just don't think that, this must be a problem or anything like that. Am I overstating that concern, or is it a real concern?
I mean, one advantage to the massive amount of closures that we've seen recently or over the course of 24, it does provide air cover. And I feel like, if you're a brand that's closing a number of locations and there's another brand announcing and another brand announcing, a couple of things happen. One is, that it becomes less of an issue and, less of, negative news headlines. And then number two, well, everybody's doing it. So, it does provide, like I said, air cover to, the consumer, where you maybe get a little bit negative press versus a situation where, you do it out of the blue and you're the only one doing it.
Mm-hmm. Yeah. How do you, what's the point at which like, look, this is a restaurant that we just need to close this restaurant? I mean, what is there like sort of like a point at which you make the decision, it's time to just shut it down?
Yeah. I mean, I think, first you're looking at the economics of the situation. So, does it lose more money than the rent you would otherwise have to pay? That's sort of, the first box to check. If it's losing more than the rent and I can just pay closed rent, which by the way, ultimately does not hit EBITDA, even though it's still cash out of pocket. It doesn't hit, your P&L EBITDA, then, make the decision. Does it make sense to close it? Obviously there's always extenuating circumstances, construction, various, external site characteristics that could impact the decision ultimately. But, starting with, okay, none of those characteristics or none of those situations exist. What is the financial performance of this unit? Do I think that I can salvage it? Is it a manager issue? Is it an operational issue? There are service providers out there that do a lot of site selection work, and they can do an analysis and say, based upon this location, the business should be performing, at X AUV or, at Y seasonality or whatever it may be. And if you do that analysis and say, wow, this is a unit that really should be performing, and maybe this is self-inflicted, you also have to perform that analysis as well and be very introspective and honest with yourself and really, a truth seeker to say, okay, I've given this everything I can. There aren't external characteristics that are affecting this. I've had, typically we look at a business that's underperforming for a year or longer as one that would be on sort of the red flag list of, okay, is this targeted for a closure?
Mm-hmm. Now, you would normally, though, like when you get to that point, you've done a number of things to try to fix it. You might have brought in different general managers and things of that nature, and you just like this thing ain't working.
Yeah. Right. I mean, you always go through sort of the salvage exercise, right? Which is, okay, let's bring in new management. Let's maybe throw some local store marketing dollars or other marketing dollars at this. Is there a discounting? Can we inject some discounting call to action to bring people in to see if we can get them to become sticky? There's a number of strategies that you can deploy to try to salvage the location. If you've really exhausted almost every strategy and say to yourself, I just can't seem to get people here. And it could be, again, the area shifted to another part of the city or town and people just aren't, for whatever reason, going here. We had a unit in a business that, actually from a demographic and site characteristic perspective was off the charts. It literally checked every single box. It should have been the highest performing unit in our system. And the traffic counts were crazy good. Turned out the traffic counts were so good that nobody wanted to pull off. And so the business actually, it was just terrible. And, we said, okay, well, maybe we can do third party and try to live off a third party because then people don't have to park, they can just have it delivered. But even the third party drivers would see the location and not want to pick up from there because it was such a pain to get back on the road after they pulled off. So, it's really just being honest with yourself about, okay, I've tried everything. This is just not a good location for my business.
Wow. So you're basically saying that was too popular, that location, that the traffic numbers were just too good. That's literally a Yogi Berra quote. And it's too crowded. Nobody goes there. I mean, but I can see that, as I am a consumer of restaurants, obviously. And then there are some times where it's just, you don't necessarily want to pull off. And it kind of speaks to the issue. There are a lot of reasons why a restaurant location suddenly, or just at one point, just isn't as viable as maybe you thought, or maybe it had been. The classic example is a new competitor opening up down the street, or, something, some changes happening with the area, demographic issues and things of that nature. Sometimes locations just, you think they were viable and then suddenly they become not viable down the road. And then you just have to make that sort of assessment.
Yeah. And I think, there's really two pieces to this, right? There's the location piece. Is this the right location for my business? Right. And like you said, that could be driven by the competitive set. Are there too many competitors where, say I'm in the Mexican segment and there's 5 other Mexican concepts in a very short distance from mine, and I'll never get the frequency I need to generate the volumes that I need to make this a profitable unit. And then there's the brand, right? Is my brand relevant? I think, and, I don't want to single out any brands in particular, but we have seen a number of brands not evolve over time, and at one point they were very relevant. And, as time moved on and competitors come in, especially in the fast casual space that, are slightly chef driven or, have components like sustainability or other, appealing characteristics. And, your brand has basically stayed the same. You've just run new LTOs, your brand becomes less relevant. And, you need to also, as, you evolve your brand, if the brands around you that are playing in the same category and are, among the choices of a consumer, as those brands have evolved and maybe passed you in the passing lane, and you're sitting there going, well, why aren't people visiting my restaurant? Why are they going over there? Well, back to the truth seeking component, have I evolved my brand so I continue to be relevant like I once was? And so, that's a non-location characteristic that could also cause you to make a decision to close.
Right. Well, I mean, restaurant business is competitive. The thing is that at the end of the day, all restaurants have to be on their game and all the time. And these days, consumers notice issues and problems spread. Word of issues spreads pretty quickly. In the social media age, you can't get away with what you might have been able to get away with 5 years ago. And people have so many choices. And it's probably the big lesson from last year. I mean, to your point, and this is a little bit beyond what, the issue of just closures, but the fact of the matter is that you have to absolutely remain on your game in all phases to continue to get consumer interest. Your operations have to be really good. Your marketing has to be phenomenal. Your product, selection has to be what consumers want, things of that nature. You've got to be on your game all the time. And it really does kind of at points go to where your locations are.
Yeah.
What they look like.
Yeah. And, everybody talks about value right now, and it really transcends beyond just menu pricing. There's been an enormous amount of price taken, over the last 4 years. No surprise to anybody, right? I don't even know what, some of the burger combos go for in Los Angeles right now, but I'm guessing, they're in the high teens probably. But that value component is like I said, it transcends more than price. It's the experience, like you said, it's the service, it's the menu evolution, the quality of the ingredients, how they're prepared. It's, the design, decor, upkeep of the facilities, right? It's the parking lots. It really encompasses everything. And, as you remain relevant and you want to stay open and not close, you have to make sure that you're remaining competitive across that value proposition. And that value proposition oftentimes goes beyond, okay, well, I'm the cheapest burger, taco, bowl in town. That's not enough anymore. You have to be a lot more and create more value for the consumer above and beyond price.
Right. That's kind of the Chili's example. At the end of the day, although for the record, one of the things that Chili's did to thrive last year was offer a discount. It was a discount. It was still a discount. It was consumers found it attractive, and it kind of played into exactly what they wanted. But another point is, you mentioned value. Consumers will spend money today. They will, and they absolutely will spend money. It's just got to be what they want. And, they've got to believe that it's worth it. And if they believe that it's worth it, they'll spend the money. And you could just pick any number of restaurant companies. I think Raising Cane's. I don't think Raising Cane's is cheap. Chick-fil-A is not cheap. By the way, Chick-fil-A is definitely not cheap. A lot of these restaurant brands that are thriving, Cava. Cava's kind of kept their prices, prices from increasing too much. But, a lot of these brands are just not cheap, but they're generating sales. Why? Because people consider them worth it, because they do a lot of things the right way. And, that's super important. That's more important today than it's ever been, I think, especially after last year.
Yeah. And look, I think I don't think the closures are over, by the way. I think you're going to continue to see more closures in 2025, as crazy as that may sound, because there were so many as of late. But again, there's the air cover component, kind of like there was air cover to take price during COVID. Everybody was doing it. Commodities were going up, labor was going up. So, you weren't alone. I think, there's the air cover component. And I think, again, this is a very hard business, and there's a limit to the amount of human capital running these businesses, and redeploying that human capital and financial capital against more productive sources. I think a lot of groups are going to come to the realization, especially as leases come up. It's not like rent is getting any cheaper. I think you're going to see a lot more groups close more stores and say, I'm better off focusing my attention and my dollars elsewhere.
Right. Do you get, when you let's say you've got a group of, say, 200 restaurants, and, of the same chain, and you decide to close, say, I don't know, 20 of them, whatever. Do you see a benefit to the remaining 180 restaurants when those 20 close? I mean, does that help your other restaurants?
Sure. I mean, we use a service called Placer. A lot of restaurant companies are using it now, and we'll show you visitation and where people are coming from. And a lot of times it's very accurate where you close and, somebody then just goes and visits another one of your locations because, it's within a certain distance that's convenient for them to do so. So you definitely see a pickup in the other restaurants. The one, sort of potential landmine of this is you are, even if a restaurant is not making money, it may be contributing to the back office support and the dollars, that you pay for your accounting or finance team and, your HR team, if you have one, and your marketing team and other resources that are applied against the restaurant. And so, the cost per location is then going to go up for the remaining locations. So just being aware of that support and, do I have the right organizational structure now that I've closed those 20, or do I need one less payroll person now because I have fewer employees? But, the short answer to your question is you definitely see a pickup. Just be careful of some of the ancillary consequences, financial consequences that may come up as a result.
Right. So how do you deal with the lease aspect of that? Because that's one of the issues, like, especially if you end up closing too many of them at one point, then you're going to have to file for bankruptcy to be able to dispose of the leases and things of that nature if you're having significant financial issues. But I'm like, I imagine, though, that there's got to be some sort of mathematical calculation that, if you decide to close some locations early, that you decide that maybe you're better off just paying the leases through whatever the end of the lease term is, rather than keep that location open. I mean, what do you do about that?
First thing is to read the terms of your lease to understand, can I sublease and assign my lease to somebody else? And what are the provisions? Can I assign it to somebody else that's an equal sort of credit risk with, or, and the landlord's approval can't be unreasonably withheld, or whatever the term may be. It's important to review that because you may be better off subleasing it, even if you're having to subsidize a portion of the rent for some period of time until the lease expires. It may be less expensive than keeping the restaurant open. So, doing the analysis on, okay, what, if I were to sublease it, am I able to, according to the terms of the lease? And then another, call is probably to your landlord to say, hey, I'm not doing well here. I'm thinking about closing this location. Can you give me any concessions? If I extend my lease for, another 2 years, will you give me a discount? Does that then make the restaurant profitable, or give you, maybe a little bit more runway to see if you can make it profitable? Does the landlord have other people interested in the space? And therefore, he may say, or she may say, oh, sure, you can vacate because I have somebody else, and, maybe strike some deal. Sometimes they'll say, look, if you pay me a lump sum, and you can do the analysis, okay, is it worth paying that lump sum versus suffering through some period of time? So to your point, there is mathematical analysis that can be done that will help you determine, okay, what are the, as I weigh the options, what are the costs of keeping it open and what are the costs of closing the location, based on researching all, rent related issues as you consider the closure.
Mm-hmm. How are landlords these days? Are they willing to? Are they are they amenable? I mean, does it depend on the type of location that we're talking about? I imagine that the landlord of a drive-through location would probably tell you to buzz off if you want some sort of deal. But if you got an inline location or casual dining, are they willing to give you those sorts of breaks?
I mean, it depends on the landlord. Certainly, as you see the more institutional landlords or REIT landlords, there's a little bit less flexibility because they've securitized the income stream from the center or from the site. And so, they're answering to another group of investors. And so they may be a little bit less flexible. So a lot depends on the landlord. You might have an individual landlord that, feels like, they're sympathetic to your situation and it might cut you some deals. It really varies by location. I would say if you have a drive-through location, those are in high demand right now. And so, chances of you being able to either sublease it or the landlord finding another tenant, depending upon, if you're out in some remote spot that, may not be as desirable, but, a lot of those drive-through locations are in high demand. So it does depend on the site. If you're an end cap versus inline, you might have an easier time with the landlord negotiating something on an inline because it's going to be harder for him to find another tenant that can fill that space. Especially if you're a restaurant that hasn't done well, it's going to be even harder for that individual to find somebody to replace you. So it does depend. A first call to the landlord, to confidentially, have that conversation and say, what can we do together where it's a win for everybody is always a good first step.
Mm-hmm. So so you mentioned one of the things you mentioned, you think you expect more closures into this year. I guess it's already 2025. Good grief. But one of the things that people talk a little bit about is that we didn't get enough closures coming out of the pandemic. And you might remember the pandemic. We thought that many of us, I certainly did, thought that there would be probably a lot more closures than there were. I mean, there's certainly a lot of independence closures. We didn't see probably as many chain closures as maybe I would have imagined. Do you think that's part of what's going on here, is that we still actually had too much supply, and this is some sort of reconciliation?
I do. And it's a great point, John, that you bring up. I think, there were, the market was saturated. I think you have brands that are encouraging franchisees to grow because that's how you grow the value of the brand. And so almost at any cost, I've often said that franchising is a contact sport, and these franchise brands do want you to build new sites. And I think that partially contributed to the saturation. I think, private equity investment coming in, one area that I think that, we differentiate is that we don't apply enormous pressure on our investments to just grow a hockey stick growth. We like to be a lot more disciplined and pick great sites. But I think, as dollars come in and investment firms have to generate returns, that they really try to apply pressure to grow. So you have, all these growth pressures and, success elsewhere. And I think there was a saturation, like you said. And I think, we're feeling some of the consequences of that with, too many restaurants and not enough mouths. And, and then obviously, and you track it in some of the, your content, the spread between restaurant and supermarkets where, the supermarket dynamic pricing, as their commodities go up and down, they can adjust their pricing to protect margins. Restaurants have a much tougher time doing that. And so, those spreads, as those change and people make decisions, the consumer that is price driven, will end up saying, oh, well, I can make this particular product at home versus going out for it. So, yeah, I think that there's definitely been a saturation.
Right. Yeah. You made one of my trigger comments, which is, pressure for growth. A lot of the publicity about last year's bankruptcies focused on casual dining and full service restaurants. People are not eating at full service restaurants. There were more bankruptcies among fast casual chains last year than there were casual dining restaurants. Fast casual chains were more likely to file for bankruptcy last year. Fast casual sales were fairly strong last year, and yet we saw a lot of bankruptcies. And a big reason for that is that you had all of these investors, a lot of these private equity investors that stepped in, pumped money into these because they were all looking for the next Chipotle. You remember that. And some companies like Mod Pizza got like hundreds of millions of dollars. And there was all of this pressure to grow. And they ended up signing leases. And I might even talk to you about this at some point. I remember talking to people several years ago, worrying about lease rates in urban areas. You remember this? Lease rates for fast casual type locations in urban areas because there was so much demand for these sites because so many private equity companies were pushing growth. And now what you have is all of these companies that end up in bankruptcy and filing for, end up in bankruptcy. They're closing locations. They're being sold for pennies on the dollar to franchisees or some low-end investors that just basically take costs out and suck whatever cash they can get out of it, with a couple of key exceptions. And so now we have this sort of situation. Pushing growth when growth is not warranted, or pushing growth in accepting higher costs on lease rates was just one of the worst things that companies did, and is one of the reasons why we had so many issues last year. It's not always because consumers stopped eating at full service, which they did. But man, that was one of the big reasons why we had so many closures. If you had to, sorry, I had to rant there.
No, for sure. I mean, with a lot of our investment businesses, we look very closely at self-cannibalization. It's a very real effect of building stores that are too close together, and understanding, okay, maybe this location I open up is system AUV for that particular brand, but what am I taking away from the 3 other locations I have around it? You're seeing, especially like you said in fast casual, a lot more what I call infill sites, where you have 2 locations that are doing very well. They put one in the middle. Now you have 3 locations. While a general benefit to overall EBITDA, at the end of the day, you do have to consider how it impacts your other restaurants. And at a certain point, that impact becomes too great. And then as everybody is doing that and building too many locations, as dollars are invested into growth, like you said, you just have to be very disciplined with growth. I can't reiterate how important it is to say, if you have a doubt whether or not it's going to be a good location, spend the time to flush out why you have that feeling, because you shouldn't grow for the sake of growing. And we saw a lot of that pre-pandemic, post-pandemic, and now we're seeing some of the effects of it. You're exactly right.
Right. Yeah, we still see it. Still, many franchises, no matter who they're owned by, pushing growth, pushing their franchisees to grow, or more specifically, selling franchises to people who have no business franchising, yada yada yada, just to get growth. And it's just problematic. That's an entire other episode. Jim, this was great. I really appreciate you joining me again on the podcast.
I so much enjoy it, John. Anytime. I really appreciate spending time with you, always.
All right. And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.